All eyes will be on Friday's jobs report after last month's better-than-expected numbers. Might we see job growth for the first time since December of 2007? And if so, what would that mean for the Fed's plan to keep interest rates steady for the foreseeable future? Joining us with his thoughts is Rich Clarida, Global Strategic Advisor at Pimco, the world's largest bond house. Rich also is a professor of economics at Columbia University and former Assistant Treasury Secretary under George W. Bush. So, Rich, let's tackle this topic because a little over a month ago you were here talking to Tom Keene and Ken Pruitt over at Bloomberg Radio, and you said that, in your opinion, the Fed would not raise rates until the unemployment rate dropped by at least a full percentage point, which is to say somewhere down into the 9. So, and at the time you thought that might happen in 2011. Anything that we saw in the last jobs report change your mind about that?
I really don't think so. I mean, obviously, we all hope that the unemployment rate falls and employment increases, but my reading in the Fed's own forecast is for unemployment to remain elevated for a year, and I take the Fed's forecast as more or less my own. So I don't think the Fed is going to do anything really with rates until 2011 or perhaps very late in 2010.
What other conditions, though, does the Fed want to see before considering a tightening of monetary policy? Well,
you know, they would want to see, I think, a sustained improvement in the labor market, which we have not seen yet. They would want to see that we have some durable source of demand in the economy other than a temporary fiscal stimulus. You know, right now, we had very modest growth in the third quarter, perhaps somewhat stronger growth in the fourth quarter, but really all that's being driven by an inventory rebound and some temporary fiscal stimulus. So I think the Fed's going to want to see some durable source of demand from consumer, exports, investment. We haven't really seen that yet.
I was speaking yesterday with Brian Moynihan, the new CEO at Bank of America. He was commenting on the state of the credit markets, which is, in addition to the things that you mentioned, pretty elemental to an economic recovery. And in his opinion, things have stabilized on the consumer side. Now, they've stabilized at a very dire level, particularly for Bank of America, which has charge-offs in its credit card business in the order of 14%. But he says that that's stabilized and that what we might see next is some fallout on the commercial side, which is principally to say commercial real estate. Would you agree with his assessment that we've seen a stabilization in consumer credit, which is to say no falling out of bed in the future?
I think it's too soon to say that for the following reason. We went through really a 20-year period of a huge increase in leverage on the household balance sheet, and at best, that leverage is just stabilized. So if you believe, as I do, the household sector in the next 5 years will be deleveraging, that means there will be more to come on this. And certainly when you talk about commercial real estate, and I'm no expert, but all the numbers I've seen indicate that that's 1, 2, 3 years still to play out. So obviously I don't see the B of A credit card data, but I don't think that we're necessarily at the bottom of this credit cycle yet.
Hey, Rich, I want to go back to what Ben Bernanke has said and what you're saying about that. I mean, hasn't he signaled to the market that interest rates have no place to go but up now? And, you know, obviously they can't be lowered any further, I don't think. I mean, isn't he saying we're going to do it and you better prepare for it?
Oh, yeah. No, I think there is a rate hike cycle. It's just a matter of when. And my view is that the markets are a little bit ahead of reality now and that they're actually pricing in 3 rate hikes in 2010. And I just don't see that. But no, inevitably rates will go up. But again, the Fed has never hiked, especially in a severe recession, until you see a sustained decline in unemployment. And by the Fed's own forecast, that's at least a year away.
Do you think he's getting any pressure from savers who, you know, we've suddenly become a nation of savers who are getting basically zero on that savings? Do you think he's getting any pressure from the American public to raise rates so they can get a little return?
You know, I actually don't think so. I think because the net effect of a hike in rates would increase mortgage rates, credit card rates, auto loan rates, and so that would be a net negative for the consumer. There is some pressure from those who think the Fed's been too easy for too long, and there are some members of the FOMC who I think would probably hike sooner than Bernanke would. So there is pressure. I just don't think it's from the consumer.
Rich, very quickly before we go, we've only got about 20 seconds left. Can the Fed afford right now, on schedule, to stop buying mortgage-backed securities?
Well, they've said they're going to do it, and they're going to stop doing it in March. And as your listeners probably know, they've bought more than $1 trillion in mortgages, and obviously that's had a big impact on mortgage rates, and we're all waiting to see the fallout from that.
All right, Rich, thank you very much. Really great to have you here. We're speaking with Rich Clarida. He is a Global Strategic Advisor to Pimco.